Hey guys, welcome back to another video. Today I'll be describing and explaining to you every ICT concept you need to be profitable, especially going to this new year. And there's so much information out there. People want to start trading. You need to know what to do. You don't know what to do. It's confusing. I'll explain it. Now, prefacing, this is ICT's concepts, not mine. This is what I used to be to trade to make money. This is what your favorite creators used to trade. And these concepts are very strong and that they have a lot of depth to them. And this is where people usually get lost. It's not hard to know what a liquidity sweep is and a fair value gap is. Knowing how to use them, knowing how to apply your discretion, knowing the depths, the differences which each one has and what they mean, and there's a lot of nuance to it and a lot of, as I said, just a lot of depth. And today I'll be going through all of these. I will be making individual videos going deeper into each one of these concepts and more, but just for a start, I want to make it very clear for people the ICT concepts you need to know. Now these are all based on liquidity. Without going too in depth in liquidity, I'll make that in a future video. Liquidity is basically where the money is in the markets, where the orders are, where the trades are taking place, where price wants to go, where price is going to trade from to the next move, where price will move from expansion to a consolidation to retracement, to a reversal, where price will go from bullish to bearish. Everything has to do with liquidity. Why? Because that is how the markets are made with market makers who their job is to give liquidity or inject liquidity in the markets. Market movers, people, institutions use liquidity, and the way you're going to be trading is trading with smart money and trading according to liquidity. So let's get through liquidity. The pretty simple liquidity concepts that you know. If price wants to take out stop orders and where a lot of stops are resting. Now there's liquidity everywhere here, although these are getting taken, whatever. Over here, let's use a good example. I'll use a good example from, what's a good example? I had one yesterday during London session. I think it was right over here. Sorry, I forgot where it was. Right here. What sticks out here? There's a few things. You have this high of this range. There's not much else to the left of it. And you have this low over here. Right? Now, I'm going to bring the concepts over just so it'll be very clear, and make it a lot smaller just so I can zoom in and it can be read. I hate how it moves on TradingView, but it's okay. Here, and then I'll make it bigger because I'm probably going to be teaching everything here. A liquidity sweep. Now, there are orders resting under these highs and these lows, and there's a lot more that goes into it. Right over here, you see not just one low, but another low, nearly at the same level. Now, what does that mean? These are relatively equal lows. Very strong liquidity pool, similar to equal lows, which just mean they're like at the 1 point difference, basically at the same level, which these are basically at equal lows actually. But you have orders under here. Price reached here, did not take these orders, they're under here. Price then took the orders, rejected them, and went up. Now this move was created because price took out the liquidity that's sitting, this range of liquidity that's sitting under these lows. That's what price took out. When people buy here, they have sell stops because when you're buying, to exit, you have to make a sell order, and these are the sell stops. Now, what does that mean? Price went here, a lot of sell stops have been hit, which allows for a lot of buy orders to be placed and price to go up, or the start of the move up at a very discounted price, which you could compare it to the supply and demand or support and resistance, whatever you want. If you look at support and resistance and supply and demand as zones, and the areas under levels, then it's similar principle. But this right here would be sell side liquidity. Why? Because it's liquidity sitting on the sell side of the curve, where these are the sell stops. Up here is buy side liquidity, because when people sell, there are buy stops sitting up here. If you want to name it as buy stops, you can name it as buy stops. So a liquidity sweep is basically when price goes into a zone of liquidity and sweeps it. This doesn't mean that it's going to reverse. Very important, I'll get into that later. Now, you have two things to do with liquidity as a trader. You have to trade off of liquidity and to target liquidity. What does that mean? Well, if price always targets liquidity, and every time you want to look for a target, you need price to have hit liquidity so you can identify which target to it moves to. If you trade while it's going to one, and I'll get into that too, you could find a move depending. And this is called a continuation. However, price can also continue. Here, price could have kept going down right away, right to here. But you would have still seen a reaction here, and again, I'll get into it. But what I'm saying is that you want price to hit liquidity for your trades, but you're also looking for the next target price of liquidity that price will go to. This is your draw on liquidity. You're basically a magnet. You're providing a zone or a level or an area, basically a price level that you using your principles believe that price will draw to. That's your draw on liquidity. For example, for me, when price hit this level down here, I believe that the draw on liquidity was up here. If you see, price barely missed it, but I actually put my take profit a little bit below. That's just something I do personally because this happens. However, price did hit this level of liquidity, and then it reversed to its next area it was looking for. Now it didn't hit this wick, but it took all of this before, and it did not have the power to go down here. It created these relative equal lows, which will now be a stronger draw on liquidity. But basically, now I use this as my draw, and price went up here. Why? Because after taking out sell stops, and I'll show you how to enter and understand why, for confirmation, price is going up. Now, there's a difference between a liquidity sweep in the sense of a reversal and a liquidity run. A liquidity sweep is when price takes this, breaks structure to the upside. Now, break a structure I don't believe is necessary, but whatever. It breaks structure to the upside and goes up. A liquidity run would be when price takes liquidity and then continues. Now, where can I find an example of this? I'll look for one over actually like trading these, but right here, price traded down, right? You see it going down right here. With this wick, it took out all of this liquidity, all of the liquidity from the Thanksgiving day. It went down. But look what happened here. Price reacted to it, consolidated a little bit, created some low resistance liquidity, I'll get into it, manipulated it up, and continued down. Why? Because price wanted to keep going to get liquidity here, which I'm pretty sure on the higher time frame was a PD array. I'll get into that too. Sorry for jumping ahead. My point is that just because price hits liquidity, like we'll take this point in liquidity and everything over here, including this low, which was really close to equal to this low, and in this fair value gap right over here, price did wick into it. It did reject it too, created a rejection candles. I'm assuming you guys know candles. A rejection candle is basically this one where price opened here, it went down, and at some point was all the way here, and then went back up, and the bottom wick is huge. Well, a bullish rejection candle. But then we see that it goes down. This is because the draw on liquidity was still lower. Now, price did react here, and it created you an entry to go down. This is what I'm saying, and a lot of people think that, and you can be a reversal trader, but you have to understand the difference between a liquidity sweep, when price takes liquidity, and a reversal. Liquidity sweep does not mean a reversal every time. It does not. It means that price has taken liquidity. A liquidity run is what I call when price takes liquidity and it keeps going. Why? Because I like to differentiate between them. Now we're going to internal, external range liquidity. As I said, liquidity sits above all of these highs. When you define your range, so let's say for me, before I took a trade, and let's draw like a line right over here, right? I'll make it a bit thicker so you could see it right here. I like a GAN box because I just need the 50% level, but you can take a fib and draw it from the bottom to the top of your range. This is the range you deducted. Everything at the top of the range is external range liquidity. Everything over here is external liquidity or external range liquidity, right? That's everything over here. It's also everything down here. Now, this high, for example, this high is internal or internal range liquidity. Why? Because again, just like it sounds like, it's liquidity inside the range. And why is this important? Because as price goes from buy stop to sell stop, it doesn't only go from external liquidity, it also goes from internal. Look at this. If you were to define this is your range, right? Actually, let's stick with this range. It'll be simpler. Price here, the top of the range, after it took out the previous top of the range. Now, 70% of the time, price stays range bound. It's important to know that. This was external, it took out external. This was external, went down, took out external, went down into a PD array, which would have been internal, took out external again, now it goes down. It took out the sell stops, internal liquidity, right? This is an internal protected low now, but internal liquidity. It goes up here, and it doesn't take out external. It happens. And I guess the range would be here. So this is the external. Sorry, let me clarify. Right now, when we're at this block of time, this is external. It goes up internally, it goes down, and takes out external liquidity, pushing the range or changing the dealing range you're working with. And then it goes up and takes out this internal high right over here. This high was internal buy side liquidity. Created this high, which will be the later new internal buy side liquidity. Goes down, creates a relatively equal low, stays in the range, goes up, takes more internal liquidity in the form of this fair value gap. I'll move this line now. Goes down and takes out external liquidity. And now we're at the point where I took the trade. Not only do we have a liquidity sweep, but when we take liquidity, we need to understand that price likes moving from internal to external, maybe a few times, maybe in different ranges. You need to know how to identify your ranges. But if you mark out the high and low, you're looking for price to trade to, one of the two, that's going to be your external. Everything inside is internal. Why am I stating this? Because when you trade and you enter here, you might think, let's pretend, without getting into why I entered here yet, let's pretend that you put it under the protected low, which I'll explain, and you target external, and let's say you targeted the when I put relative equal highs, I target the lower one, even if it's a few points. Now you would have hit this trade, but right here, this swing high, your first point of internal liquidity, internal buy side liquidity. And what did I state before? Price likes going from buy side to sell side. In a different world, your trade sadly can hit here and go down. It can, and it does, and it happens all the time. Here is an example of a liquidity run, for example. It did not sweep here, it kept going. Now on the 5 minute, it looks like that, but on the 1 minute, which I wish it did not move me like this, on the 1 minute you see it reacted to it and then went back up, and it traded off this fair value gap and respected it, and it went up, and you could see that other people would have, if people who trade on the 1 minute could have capitalized on that. Now it went up to internal and kept going to external. That's internal external liquidity, happens in all time frames, and I'll explain later at the end of bias. Now we're gonna get into high time frame, low time frame liquidity. Let's look at the daily. I'll mess up with these words, but let's look at the daily chart. And where is it? Here. On the daily chart, what is high time frame and low time frame liquidity? High time frame liquidity is what it sounds like. Liquidity on the high time frame. This can be your previous day high, your previous day low. So right here, price today. Delete these. Price today. I'll write it out. Previous day high and previous day low. Oh, what I read? No, sorry. Previous day high, and then here, this is your previous day low. When price opened today, it opened down here. It traded up into this previous day high and reacted to it. Price sweeps liquidity on the high time frame. Price is drawn to liquidity on the high time frame. Price makes the same type of liquidity runs and liquidity sweeps right here. Perfect example of a liquidity run. Price hits this big low, rejects it, goes up the next day completely, and then keeps going down. And you see the entry would actually be up here. When you learn market maker models, you'll understand. That's a liquidity run. Here is a liquidity, like they're all liquidity sweeps, but here's like a proper reversal when price broke structure and everything. It all happens on the high time frame. Why am I specifying high time frame, low time frame? Because high time frame you use for your bias, and low time frame you use for entries. Why? Because I'm not taking daily trades. I'm not a position trader. I'm not a swing trader. I'm not any one of those. But let's say you are last week here. You see price over here. It swept this sell side. External, by the way, external liquidity. What can you expect it? Regardless, just like here, if you were expecting a run down or go up, you'd expect a reaction up. You're still expecting the sweep. You're not expecting a full reversal yet. You don't have confirmation for that. But just like how here it swept and it went up, you're expecting a move up. When you're intraday, in your 5 minute, 4 minute, 3 minute, 2 minute, 1 minute chart, even 15 if you want to trade 10 minute, whatever, you're looking for longs. Why? Because currently on the high time frame, price is delivering from external sell side liquidity. Not only are you delivering off external liquidity, probably to internal, but you're also going from sell side to buy side. This is crazy strong bullish. Here, it was not internal. You could define your range here, and it would be in this range as internal. I mean external to internal. I did. It's in this range. If this is your external low, price did still go into internal liquidity in lower time frame stuff. But this was just a very obvious range to have. This low swept this low. This is the big Trump tweet. For price to move down here, if price continued going down, you'd expand your range to be somewhere here, you know? But you use these high time frame liquidity targets to create your bias. You also use them for a draw on liquidity. When we were here last week, this level, right? This level, I'll get rid of these previous day high, previous day low, and this level, relatively equal on the daily, and you have a bearish fair value gap. When you're here and you're going up, you're looking for internal liquidity. These are your internal liquidity targets. These are your buy side internal liquidity targets, and these are your draws on liquidity. Because you don't look, you're over here, you think they're going to go up here. Now, granted, price does move down these days, but overall it moved up. And this is how you have drawn liquidity. You use liquidity sweeps. You use internal, external, and now you differentiate between high time frame, low time frame. Everything I showed you before from execution, and I'll go into it later, was low time frame. High time frame is for your bias. Your daily bias is literally you taking the same principles, but instead of going into a trade, you were just imagining you go into a trade on the daily time frame. What would you target? That's your bias. And then you're trading the moves, the little blocks that go into that. The same thing with liquidity delivery. We're delivering from here. It's how price reacts to it. When we hit these levels, we can expect a reaction. Here you see we consolidate a bit, and I think we're just going to keep going up. Next levels are up here, and then it's all-time highs. Now, different highs and lows that you can use. You have previous day high, previous day low. There's a really good model called I forgot what it's called, but if you know T-Trades, he teaches it. You can really base where you think price might go on the previous day candle. Let's start it over here. You have this day, and then you have this day. Now, this day was bearish, right? And the fact that it's bearish, you can already target the previous day low when price opens over here and hit it. And even though it stayed in this range of the previous candle, it went down. I'll make a video on this, but I'll go quickly. This candle was bearish, but it's a clear rejection candle. You can expect the previous day high to be taken. This day was bullish. You can expect the previous day high to be taken. This day was bearish. Now, you would expect the previous day low to be taken, and it wasn't. It doesn't work 100% of the time. This day took out the highs and was bearish. You can expect the low to be taken. This day was bearish. You can expect the day low to be taken. And you think this is hindsight, but I'm telling you, you start paying attention to this every day. This day was a bullish rejection. You can expect the previous day high to be taken. Bearish day, you can expect the previous day to be taken. You see how this goes? Now, you can use these previous day highs and lows, and this happens on the weekly. Oh, whatever. Okay, I'm gonna have to delete these one by one. I'll just copy this, and yeah. Previous week low and previous week high are the same thing. Sessions, I'll show you, in relative equal and equal are the strongest liquidity draws and places to take trades off of. Now, when you're on the 5 minute, you're not looking for the reaction off the daily exactly because you're not going to know where that is. It's a bigger range. When we swept this low, the range which we went under the line was 250 points. You're looking at these as targets. On the low time frame, you're looking for the reactions of the sessions and relatively equal. And then low resistance liquidity, I'll get into it. Now we're going to move on to order flow. I know that was a long one. I don't even know how long I'm going on for. Where can I see how long? I'm going on for 23 minutes. I'm sorry. This will be a long video. But this is really me trying to explain to you very clearly so you understand everything. Order flow. Order flow is simple. Order flow is the direction the market will be trading off of. This is your bias. I already went over some things. Order flow, you will use liquidity like this. You're going to use sell side, but what you're going to use is internal, external liquidity. You're going to have targets, but you're going to look at fair value gaps. PD arrays, you can look at breaker blocks, you can look at order blocks. I personally recommend fair value gaps. Let me explain to you what I mean. Over here, when we hit all-time highs, price displacement is a strong move down and created this daily, SABI is a bearish, I'll write out bearish to make it more easy, bearish fair value gap. And we respect it. Now respecting it means going into it and then rejecting it, like rejecting as in trading back down, or not touching it. This is a bearish indicator. We go down, we go up, we have this big rejection candle. This is bullish. This is based on candles. I don't really use candles. And we also, at this day, inversed this whole gap. Inversing another one. This is a new week opening gap, a bullish one because we jumped up. These were fair value gaps that were disconnected by the gap. And it doesn't matter if there's a little bit here. We passed the middle point of this bottom one even, and that's bearish. This day we go up and we create a bullish gap. This is shorter term bullish because again, we still have underlying bearish sentiment. And then when we inverse this, now we're very bearish. And look how we trade down. Now price trades into here and keeps going down. More bearish. These are bearish indicators. So now what I would do is my order flow here would be bearish. I'm looking for shorts. Maybe this day I'd mess up, but these days I'd be right. Over here, when we deliver off here, that's a big bullish sign for me, even though we have these bearish gaps. Now we created this volume imbalance, this fair value gap. We reinverse this bearish gap, and now we're bullish until we reevaluate every time we hit, and we might respect the bearish point, or like when we're creating, like look here, as we were bearish, 4-hour fair value gaps being respected, instantly inversed any 4-hour bullish, creating these 4-hour bearish. Here temporarily we were bullish, true, and then we inverse them all, create bearish gaps, respect them, create bearish gaps. When we go up here, we don't even inverse any, and we instantly have this big candle. But then here you have to understand, we took the liquidity. We're going to have short-term bullish. But there you see that the bullish is being respected, and it's still holding up. That's your order flow. It's how price is reacting to fair value gaps, other PD arrays, and liquidity concepts. It's much faster because I went through all the liquidity at first. Now time. Now we're going to go back to 5-minute, and I'm going to clear it, and I'm going to bring it back when I'm over here. What is time-based trading? Oh, and my text is just disappearing. So over here. I don't know why it's like that, but I'll fix it for next time. I won't do this again. Look at time. Time is time has a big effect on when people are trading. This is including daily times like holidays where there's no institutional activities and the markets just move sideways and they're very unpredictable and volatile, but like not in a way of a lot of volume, but in the way of you're not going to find good moves. It's also within the day. Sorry, I was like looking here and like realizing that there were good trades here, but I'm making this video and it's fine. Today was not a great trading day in my opinion. Times to trade. You can look at kill zones, which I'll mark them out over here. There are also the silver bullet times, which are for the smaller time frames. I'll just go from 7. I'll mark out 8:30. I'll mark out 9:30, and I'll mark out 12 and 11, and I'll explain why I mark all these zones. Over here, this is the Asia kill zone. It is between, I'll write it in 24-hour time, but no, I'll write it in not 24-hour time. It is between 8 p.m. to 12 a.m. This is when the Tokyo market is strongest, and again, a lot of time Asia will never be as big as London, and it'll never be as big as New York. But you can trade relative to the amount of volume there is. You could trade Asia kill zone, and during these times, there will be the best moves for post-market Asia. There will be good moves here and there. You will find them. That's Asia. Now between 12 to 2, it's pretty dead. Then you have 2 all the way to 5 a.m. and this is the London kill zone. I personally love trading during this time because you get pretty clean moves and not too much volume, but a good amount of volume. And for me, where I live, I can trade this during my morning. Not if you want, you can wake up in the middle of the night to trade it. London kill zone is right here. You can see there's more volume, price moves more usually, and in between these times you have from 3 I thought I clicked the line. Yeah, from 3 to 4 you have the London silver bullet, where if you're trading, let's say on the 1 minute, 2 minute, during this time specifically there will be the biggest moves. Between 5 and 7 is pretty dead, and then you have 7 until 12, which is overall New York, let's write this, pre-market to London close kill zones, because which is from 7 a.m. to 12 a.m. or 12 p.m. sorry. Why? Without getting too confusing, between 7 in the morning to 9:30, this is the pre-market kill zone. I'll get rid of this. You don't need this anymore. Can you go over this? Pre-market kill zone. It's from 7 a.m. to 9:30, where market opens, so it's not pre-market anymore, right? There's a lot of news events that come into this time. It's very volatile. As you can see, you get these crazy moves that happen at 9, at 8:30, even at 7. Then you have from 8:30 to 11, you have general, this is just the New York kill zone, right? It's the strongest time from the 1 hour before the pre-market to the 1.5 hour after. It's the strongest overall time from 8:30 a.m. to 11 a.m. I don't know, I'm saying a.m. And then you have, I'm sorry, it's going to be confusing. You have 9:15 to 11, which is the New York AM, because it's the open time kill zone. And then this last hour is called the London close kill zone. And the text doesn't fit, but it's okay. Now, this all looks like a ton of shit. So here you can screenshot it, but and there's also silver bullet between 10 to 11. There's also 1 p.m., but I'm not gonna go over PM because it's I don't know. You can trade it. You can watch ICT videos on it from 2 to 3 p.m. It's also silver bullet, but the overall time isn't great. I'll make this look a lot prettier. I'll get rid of all these lines. But yeah, these are during the times you want to trade. Now it depends on your time frame. The smaller these time frames, then it's for the lower, like for like the 1-2 minute, and then when you go up. But I would suggest simply from 8 p.m. to 12 a.m., from 2 a.m. to 5 a.m., and from 7 a.m. to 12 p.m. you should be trading. You can find moves here in these dead times, and you can make it more specific so you can be on the charts less, and you can make it larger to be on the charts more. But these are just times where people are trading more. After from the few hours that are not in those time frames, don't trade. And if you're gonna be trading these kill zones, pick 1 or 2 to get good at, because they're different. They behave differently, and you have to be consistent. And in order to do that, you need to pick these times. So what we went over liquidity. We went over order flow, which is also based on it, but order flow specifically. We went over time. Now we got to go over entry, and then we go over just trade management with liquidity, because it's a thing. It's how I manage my trades. So if I go back to my trade, which was over here, how do I enter? Every single, and I mean every single ICT, every single ICT strategy comes down to a liquidity sweep slash key level or range hit, and a confirmation of the following move or reaction. Every single ICT strategy comes down to this. Now, how do I trade? I look for a liquidity sweep, right? This is my liquidity sweep. Then, as price is sweeping the liquidity, I look for a fair value gap created, right? Created one up here. Now I'll mark it out and I'll explain the difference, right? These are fair value gaps that were created from the liquidity sweep. What else do I look for? I now look for this fair value gap. Now, okay, before that, I will take a fib, mark the swing low and the next swing high, the first swing high from the move that made the displacement. I'm only taking trades under this 0.5 level, and I'll explain that. And this is where the concepts come together for your trading. So I'm going to get rid of this. This is my 5-minute FEG. Now I'm only labeling this, it's bearish, and then I'll wait for the inversing of it. When price has a candle close above it like this, it's a 5-minute inverse fair value gap. What does that mean? Price displaced lower, showing a lot of bullish order flow in the low time frame. You see it's downtrending too. Once it hits this liquidity and is delivering off of it, it shows you that the order flow has changed, because as I said, order flow is based on how we're reacting to PD arrays, and it happens on every time frame, including your entry time frame. When we inversed it, we now have turned this right now into bullish. Now I don't know how long we're going to stay bullish for, and in some cases price instantly goes down. True, but we are usually bullish until we hunt the next internal liquidity or the next any point of buy side liquidity, at least one. Now, once price inverts this, I'm looking to enter. You can enter on the candle close. Now, where do you put your stop loss? You put it under the low. Now, you might be thinking, but we're talking about liquidity being under highs and lows and all that. If it were a real liquidity sweep, this will be a protected low. A low, a wick that just formed after sweeping liquidity and reacting off of it, is a wick that's high resistance liquidity. I was going to get into low resistance, high resistance soon. It's high resistance liquidity. Why? Because it took liquidity. It was the wick that had the reaction. It took the orders and had the orders placed. And price does not want to go there. It's trading away from there. That's a protected low. That's where we put it. And you can put it at it or a tick below it. It's fine. Where are you targeting? The most obvious way to target the other end, the other end of your what's it called? External liquidity. If it's relative like this, I personally just made it again 1 tick under or 2 ticks under. I got a perfectly ticked price here. It was diabolical. It did not hit this, but I did not wait that full trade. My first take profit, it could be here, but I put it right over here. Why? Because this is a low resistance liquidity, internal liquidity. What is low resistance liquidity? You could see it as trendline liquidity. Why? Because these are highs taken, and yeah, this might be a bit protected. It took out here, but in the grand scheme of things, when you have, and I'll draw this out to make it a bit more obvious. When you have a low and it got taken and we react off of that, this is a protected low, right? This is called a high resistance low, or high resistance liquidity, because that's what liquidity is, highs and lows. But when you have a trend and your trend is like this, perfect, right here, or actually let's look at one that price has taken, and let's look at a better example just to make right here. Very simple. See these lows? You see this trend right here? And we're looking at not the actual trend line to get hit by the last major point of liquidity, meaning that you look at it like this. Why? Because this low is created, and this low is created, this low is created, and they're not taking each other out. This low is created, and when price goes here, there is so much liquidity sitting under these orders. They're not taking each other out. If you had a wick that was like here, like this, one, this would be a high resistance low, but it already took out all this liquidity. There are sell stops under here, and then over here, and over here, and over here, that are not being taken. And they're not being taken because they're being engineered. This is low resistance liquidity. Price runs through low resistance liquidity. Price, when it goes into it, it eats it, and it could reverse at the end of it. It could reverse at any point, but usually it goes through all of it to the last low, like this. And even then it kept going. Now, why am I drawing this? I'm drawing this because over here, I'm expecting price to run through these. But I mark out the first point and the last point. This low is a protected low, high resistance liquidity. These lows maybe took some internal, even smaller internal liquidity, but have not taken out like this low right here. This is the high resistance one. Usually the external. And so I would take profit firstly over here and move my stop loss to break even. Move my stop loss to break even after I took out the first internal high. This is a high resistance high in the internal. Again, you have to separate, you have to go into depth. But this is where I take my first one. I did not take profit here, even though you can, because I'm already expecting if price to go through here, it'll go through all these highs. Why? Because at the end of the day, there's stops above all of these, and price likes to run through them before making this big move. And see how price left these ones untouched, and they were relatively equal? Look at that. You were down here. You were down hundreds of points. But price goes up just to this level. And then after that, it created this protected high because it took out these equal highs, and it kept taking lows, and it made here perfect low resistance liquidity run. Low resistance liquidity here. These are your triangles. Now, again, you're not pattern trading, but you have to understand this is how you should look at them. Price ran all of them, took these, took this, reacted to the bottom one, sweep, goes up. This is the retracement. The retracement, because I didn't go into it, but you can enter off the top here, but I'll go into it quickly and I'll return that I got ahead of myself. You can enter off the top of the inverse. I personally enter off the retracement into the inverse just for better RR, as long as it stays under. So here it would have been okay, but if this candle, for example, was like closed up here, I would wait for a retracement into this inverse area. And if it's a BPR, which is basically if a fair value gap like this is an even stronger point of retracement. You know, if I was going to trade up, I would wait for the retracement here and go. And this one didn't go well, but in general. And so I would wait for the retracement here. And as I manage my trade, I look for liquidity targets. That's why I'm putting my take profits, putting my stop loss under the protected low. And why do I make this 0.5? Because it's from the first point. I guess I'll put it from here. It's from the first point that I'm taking my profits at, just so it can at least be 1-to-1 RR. I'll go into that in depth in a different video. Anyways, here you have a lower liquidity run. You have another low resistance liquidity. You go here. This is your protected low. Look at this. Perfect entry right here. Perfect. This is the, we'll mark out this is the liquidity target. These are like two equal highs, but we'll mark them as one high. Price took out this liquidity. It goes down. This is our external liquidity. Took the external liquidity, sweeps this, runs through the low resistance. I told you, price runs through low resistance liquidity. You want to be trading into low resistance liquidity during times you can. Great liquidity target. We have to be aware of the first point. It might just create a new low. Price takes out external low, external, this point would be the high resistance liquidity. Sell, you don't need to, I just usually put sell side liquidity. And look at the reaction. We had a displacement down, just like I said. This is the first swing high. You have, this is the inverse. This is the 5 minute, I like 5 minute. 5 minute inverse fair value gap. Now this candle closed above the equilibrium. I'm gonna wait for retracement. I like the consequent encroachment. What you could see though is that here you have a BPR. Now you also have one up here. This one's larger. This is a BPR because you have a fair value gap through a fair value gap. So for the sake of balancing risk reward and getting the trade on, I would enter right here under the protected low. And you know what? Even if you see hindsight, I'll enter at the center at the consequent encroachment at the middle of this inverse fair value gap. And it would have entered me right here. But if I were to enter down here, I would have entered off this retracement. Don't be scared to trade when price is running into you. You're getting the best entries. Now, my first exit will probably be, even though this is the first swing, at these highs right here. This is my first exit. Price could reverse up here. And then I would exit over here. Or I would just, it depends on your risk reward. But then look at the way back. There's nothing above here right now. Price reversed here. Let's clear everything. Price took, this is the new protected high. Price reversed, inversed. There's two fair value gaps, but let's go to the top one. Let's create the range for the creation of it, right? It's in a big discount. And look at this. Price. Trade it back into it. Let's use the bottom of it just to get the lowest risk reward, just so it's not hindsight. Protected high. And where would I target? This is a prime example. Perfect example of why I don't instantly target the lowest, the lowest external low. And this is why you take profits and why you move your stop loss to break even at the first internal low created. Look at this. It's a 1.83R trade. And what happens after here? It reversed. Because price does not summons the trades from internal to external backwards. There's no rules to it. You have to be safe. When price hit here, I would have had to take profit and move my stop loss to break even. Now when price ran up here, I would have just made partial amount for my total trade at 1.8. If that was half my trade, I would have made 0.9R. That's fine. Price re-sweeps here and instantly dips, and then now we have today's price action. And yeah, that's my lesson. These are the only ICT concepts you have to know. Write it, liquidity in the form of liquidity, liquidity sweeps, external and internal, sell side and buy side. Prices goes between these two, back and forth. Draw on liquidity. This is your targets, and liquidity sweep is where you're entering off of. And then you have low resistance and high resistance. Liquidity, high resistance is your stop losses. Low resistance, you're just trying to trade into, and price runs through there. Liquidity, and your targets are at the end of those. And yeah, and then you have the different highs and lows being session highs. So you saw the kill zones I marked out? That's the time-based liquidity. You're looking at the highs in those kill zones, and as long as they're not reswept after. And those are big draws on liquidity, or on the daily. And then you're looking for, and the rest of them come into order flow, which will be what liquidity is price delivering from and to, and how is price reacting to fair value gaps on high and low, or just high time frame for bias, high time frame. And see, that's your drawn liquidity on the high time frame. See this, oh sorry, here, right, this is what I missed. High time frame and low time frame. Move it over here. Low time frame liquidity. Low time frame is for your entries and intraday. High time frame is for your order flow, for your buys. Then you have time, trade during kill zone for higher volume liquidity, which is just more orders. There'll be bigger moves. There'll be more volatility, and your trade ideas can come to life, and price won't just move sideways. Entry, enter off of liquidity sweep, a reaction in the direction of order flow. I took longs because I was bullish. Here, I waited for price. Price will always go up into sell and buy side liquidity. You gotta, when you trade a liquidity run, when it keeps going, it's because you're trading only in the direction of your order flow. And IFVGs and IFVGs. And to manage trades, we have our stop loss at protected low, take profit at first internal liquidity, like internal, let's just say internal swing, internal let's say internal liquidity target, yeah, and then the external, and move to break even at if price hits first TP. And yeah, this is the ICT. I know it was a long video. I didn't plan for it to be this long. I hope you'll sit through it. But these are the only ICT concepts you need to be profitable. And I'm sorry for the long video. Thank you so much for watching. I will make a video on each one of these, shorter and to simplify on them, and I'll keep making videos. I just wanted to get one out of the way to explain all these concepts. It's a lot, but what you can do is look at each one of these, whatever you understand or don't understand, and get more into depth with it. And that way, you'll be profitable, you'll be making money from your trades, and you won't need to keep trying to understand these things over and over again. You have everything you need. Thank you so much for watching, and yeah, until the next video, good luck trading, and be safe in the markets.